Welcome back to the deep dive. We have a really fascinating story for you today. We're going inside one of the world's most historically successful and, I think it's fair to say, most controversial corporations. This is a story about shedding a toxic name, making some truly billion-dollar bets, and a long, complicated legal battle that really forced a fundamental change in how the company operates.
It really did. We're diving into Altria Group, Inc. Now, for those of you who might not recognize that corporate name, this is the company that used to be known as Philip Morris Companies, Inc. Today, it's this massive American corporation behind some huge tobacco names, mostly focused here in the U.S. market. But its current structure is, well, it's a labyrinth of spin-offs and strategic investments.
And that structure is exactly what makes this deep dive so compelling. I mean, its main, longest-held asset is still Philip Morris USA. That's the domestic tobacco arm. But Altria is, it's no longer just a cigarette company. They have these major stakes in the global brewing giant AB InBev. They've plunged, $1.8 billion into the Canadian cannabis market with Cronos Group. And with a pretty startling irony, they're now investing in specialized medical research companies.
It's an immense, powerful financial entity. It's listed on the S&P 500, which is a clear signal of its continued financial dominance. Though it's worth noting a little historical detail here. It used to be a component of the Dow Jones Industrial Average, the DJIA, but that was until 2008. The spin-offs that year were just so vast that it actually forced the company's removal from that index.
Okay, let's unpack this. So we're looking at a company trying really desperately to evolve its identity, but it's carrying this huge amount of historical baggage. We have to understand the strategy for escaping that past. And the name change from Philip Morris to Altria, that feels like the starting line.
That baggage is the central and, I'd say, inescapable tension here. The rebranding to Altria happened back in 2003. And you have to remember the context. This is right when the legal and regulatory pressure against the tobacco industry in the U.S. it was reaching a fever pitch.
Yeah, and when a company with a name like Philip Morris, which is globally recognized, a multi-billion-dollar brand, just jettisons it, the public reason is never the only reason. So what was the official story?
The stated goal, according to the company, was to emphasize diversification. They argued that the old name, Philip Morris Companies, Inc., it just narrowly defined them as a tobacco business. But, at the time they held this enormous 84% stake in Kraft Foods on top of their massive international operations. So Altria was supposedly created to reflect this bigger, more diverse identity. The name itself comes from a Latin root meaning high, sort of suggesting lofty values.
But the timing of it, right in the middle of all these escalating lawsuits and public health criticism, it just screams that the name change was defensive. Was it really designed to mask the association with tobacco?
The sources we've looked at strongly suggest that the external perception was, it was heavily about damage control. We actually have documentation from the company's own branding consultants, the Worthland Group. They noted internally that the name change offered the possibility of masking the negatives associated with the tobacco business. It was an attempt at corporate insulation, trying to shield those profitable food and international assets from the perpetual political and legal attacks aimed at U.S. tobacco.
So if the tobacco division gets hit with another massive lawsuit, this new diversified corporation, Altria, it just looks a little cleaner to Wall Street and to the public. It's a corporate shield built on semantics?
That is precisely the motivation, and the irony in the name choice is, it's almost astounding. Altria claimed it meant high, but the renowned linguist Steven Pinker was, let's just say, highly critical of this attempt at corporate spin. He called it an egregious example of phonesthesia.
Okay, let's pause on that term. Phonesthesia. For you listening, what exactly does that mean in this context?
Phonesthesia is the association of certain sounds in a word with specific meanings, often subconsciously. So think of words that start with gla, like glimmer or gleam. They often relate to light. In Altria's case, it has the first four letters of altruism, ALTR. Pinker's argument was that the company was actively trying to exploit this linguistic similarity to, and I'm quoting here, switch its image from bad people who sell addictive carcinogens to a place or state marked by altruism and other lofty values.
That is a critical insight. So they weren't just changing the label on the can, they were attempting to perform a kind of linguistic baptism to wash away decades of controversy, hoping the new name would imply virtue. And that right there sets up the whole critical lens for this deep dive. How much of Altria's strategy today is genuine evolution, and how much is just sophisticated corporate spin to keep the core business going? The name change in 2003 was really just the beginning. The next big move was this radical, almost surgical restructuring of the whole corporate body. That happened between 2007 and 2008. Altria executed two massive spin-offs. Why the immediate and drastic need to divide the company?
Well, the main driver was really twofold: legal insulation and, of course, maximizing shareholder value. The U.S. legal environment was just becoming toxic and unpredictable for the tobacco industry. So by dividing up the empire, Altria could separate its high litigation U.S. core from the potentially higher growth, lower regulatory risk international and non-tobacco businesses.
Okay, so let's detail that first major spin-off, the divestiture of the food giant.
Right, that was Kraft Foods, Inc. In March of 2007, Altria spun off its remaining 88.1% stake. They distributed those shares directly to Altria shareholders. This really completed a long process of decoupling itself from that huge food conglomerate. And the strategic reasoning is pretty clear. Kraft was stable, valuable, non-controversial. But its stock valuation was arguably being dragged down by all the political and legal baggage of its parent tobacco company. Separating them unlocked value for shareholders.
And the second spin-off, Philip Morris International, that was even more pivotal for the future of the tobacco industry, right?
Absolutely. In March 2008, the entire international arm, Philip Morris International, or PMI, was spun off. Altria basically just distributed all of PMI's shares to its existing stockholders. This created two completely separate, publicly traded tobacco giants. And it was, a masterstroke of financial engineering. It was designed to insulate those lucrative global profits from these crippling U.S. litigation judgments.
That division, though, it must have had major operational consequences, especially for the U.S. workforce and the manufacturing base. That's a detail that often gets lost in the big financial press releases.
The consequences were immediate, and they were severe domestically. As soon as PMI became independent, its former subsidiaries, which were massive buyers of U.S.-grown and manufactured tobacco products, they just stopped those purchases.
Right.
And the loss of that colossal international demand, it created an immediate glut of capacity in the U.S. operations.
Wow, that sounds like a direct hit to the domestic production line. What was the immediate fallout on the ground, particularly in the U.S. manufacturing heartland?
The immediate result was painful. Starting around 2007, it led directly to the closure of a modern, newly renovated plant in North Carolina. And across the board, Altria's U.S. manufacturing capacity saw about a 50% reduction. This triggered huge layoffs, induced early retirements, a massive workforce reduction that affected thousands of employees and contractors in Richmond and North Carolina. The human cost of that spinoff was substantial.
It's the price of division, essentially. They paid for their legal and financial insulation with American manufacturing jobs, and meanwhile, they also finalized the move of the corporate headquarters.
Yes, the headquarters officially relocated in 2008 from Midtown Manhattan, New York City, to Henrico County, Virginia. The timing was strategic. They consolidated their executive function right next to their massive operational footprint.
The company claimed this was a pure cost-saving measure. Was that the main driver, or was there more to it?
Cost savings were certainly paramount. A spokesperson at the time estimated the move would save the company over $60 million a year just by trading expensive New York City corporate infrastructure for lower-cost Virginia operations. But it also reflected a practical reality. The vast majority of their operational, research, and manufacturing staff had been based in or around Richmond for decades. Moving the executive core there just streamlined decision-making and reinforced the corporate ID with the tobacco heartland.
And the sheer physical footprint they have in the Richmond area is substantial. That makes the move seem pretty logical.
It's still massive. The headquarters is in Henrico County. More importantly, they have the Altria Center for Research and Technology in downtown Richmond. That's a vast 450,000 square foot, $350 million facility that houses roughly 600 scientists and engineers. Plus the manufacturing center in South Richmond, which, despite those closures we just mentioned, is still a critical operational hub.
So the immediate result of this division is maybe the most telling metric. When these two corporate entities, Altria and Philip Morris International, emerged, which one did the market judge to be the bigger financial force?
The global arm, PMI, proved immediately dominant. Just 2 years after the split, in 2010, the remaining domestic company, Altria Group, was ranked at Fortune number 137. Its former asset, Philip Morris International, ranked significantly higher at 94th. So this shows that while Altria kept the brand heritage in the U.S., the truly massive growth potential and operational value unencumbered by U.S. litigation risks went with PMI.
So Altria kept the legal risk and the domestic market, while PMI took the financial engines and the global market potential. The strategy was crystal clear. Compartmentalize the risk by severing the operation. This corporate shuffling, the rebrand to Altria, the splitting of assets, it was all happening against the backdrop of this intensifying legal nightmare. Let's move to the core of that legal reckoning now, and the findings of civil fraud.
Right, and this is where we move from corporate structure to corporate deception. The pressure really culminated in that powerful 2006 federal court ruling. It didn't just find them, it established guilt. Altria, along with R.J. Reynolds and others, was found guilty of civil fraud and racketeering.
Racketeering, that's a serious charge, usually reserved for organized crime. What specific acts of sustained deception did the court identify to warrant that kind of finding?
Well, the finding covered decades of systematic denial about the health effects of smoking and secondhand smoke. But one specific, highly publicized element involved the fraudulent marketing of light and low-tar cigarettes.
The idea being that the public was deceived into thinking these products were safer, correct?
Precisely. For example, a lawsuit claimed this marketing constituted fraudulent misrepresentations under the Maine Unfair Trade Practices Act, or MUTPA. The core finding was that the companies knew these products were not safer. In fact, because of the way smokers changed their behavior, taking deeper drags or smoking more often to get the nicotine dose they needed, the risk was often the same or even higher.
But the truly shocking revelation, the thing that exposed the calculated nature of the addiction, wasn't just about marketing lies. It was about the fundamental chemistry of the product itself. This is where we need to get into the technical details uncovered in that ruling.
This is the most crucial takeaway from the 2006 case. The court found evidence of a deliberate, highly sophisticated strategy of chemical manipulation, and was designed specifically to maximize product dependence.
How exactly was that articulated in the court findings?
The findings stated, and I'm quoting here, that the defendants, quote, altered the chemical form of nicotine delivered in mainstream cigarette smoke for the purpose of improving nicotine transfer efficiency and increasing the speed with which nicotine is absorbed by smokers. So this wasn't about adding flavor or making the tobacco burn better. It was about engineering the drug delivery mechanism itself.
Wait, they were engineering the speed of the high? They were essentially optimizing the rush that creates addiction? How did they do that? How did they achieve that faster absorption rate?
The mechanism was manipulating the smoke's pH. And they did this by adding a common chemical compound, ammonia, to the tobacco. In chemistry, this process is known as freebasing.
That term, freebasing, it carries instant connotations of increasing the potency and delivery speed of controlled substances. Explain exactly how adding ammonia does this in a cigarette.
So nicotine exists in two forms, a salt form and a freebase form. The nicotine in its natural salt form, which is what you find in raw tobacco, is less volatile. It's absorbed pretty slowly by the body. By adding ammonia, you increase the alkalinity, you raise the smoke pH. This chemical shift converts the nicotine into its highly volatile freebase form.
And what does that freebase form do once it hits the lungs?
Freebase nicotine is far more easily absorbed through the membranes of the lungs and the respiratory tract. It hits the bloodstream much, much faster and reaches the brain more quickly. The court found that this manipulation caused smokers to be exposed to higher internal nicotine doses and become more addicted to the product. It's an artificially enhanced rapid dose delivery system.
This is the aha moment that was revealed in court, and the timeline here is critical for that racketeering charge. When did the company know this manipulation maximized addiction, and who authorized it?
Internal documents that came out during litigation showed that these companies had been researching the effects of ammonia additives since the 1970s and 80s. They were documenting its impact on nicotine uptake and addictiveness. The court found this was a calculated, long-term strategy. And the racketeering charge comes from the fact that they implemented this sophisticated chemical strategy to maximize dependence while at the same time engaging in these public disinformation campaigns, stating under oath that they were just selling a legal product and disputing the science linking smoking and disease. They knew their public statements were false.
The sophistication of the fraud is what's so stunning. They weren't just neglecting to warn people, they were actively and chemically engineering their product to ensure maximum rapid addiction, right up to the point where they tried to rebrand themselves as Altria, suggesting altruistic values.
The duality is staggering. The legal finding confirms a deliberate, hidden, chemically optimized product designed for dependence, running in direct opposition to the lofty values they claim the corporate rebrand represented. This historical foundation is crucial for understanding the high-risk decisions they're making today.
With the public health landscape shifting so dramatically, litigation costs soaring, and their international engine now totally separate, Altria had to pivot aggressively. toward new revenue streams. And this has resulted in a series of extremely high-stakes, volatile acquisitions in what they call next-generation nicotine and related markets.
Right. Their early diversification attempts before the massive e-cig push focused on consolidating adjacent markets. So in 2009, they bought UST Inc. This was key because it ended any internal competition and brought the dominant smokeless tobacco brands Copenhagen and Skoal under their U.S. Smokeless Tobacco Company banner. It cemented their domestic dominance in that sector. It also included their wine business, Chateau Ste. Michelle, which was a nice, non-controversial asset.
But their internal attempts to catch the e-cigarette wave, they failed. They couldn't innovate successfully in-house.
That's a crucial failure point. Altria launched its own e-cigarettes, the Mark 10 and Green Smoke brands, but they really struggled to gain any market share against the emerging competitors. They eventually just discontinued both brands in December of 2018. And that failure set the stage for one of the most volatile financial decisions in recent corporate history.
Which brings us to the famous, or maybe infamous, JUL Labs acquisition. This was the moment Altria decided that if they couldn't build it, they would just buy the fastest-growing player in this space.
In December 2018, Altria finalized the acquisition of a 35% minority stake in JUL Labs for a colossal $12.8 billion. And to put that number in perspective for you, that was more than the entire gross domestic product of several small nations at the time. It was a staggering bet that the e-cigarette market would just continue its exponential, unregulated growth forever.
That valuation was clearly the high watermark for the company's market cap, which was valued at over $118 billion that same month. They were riding the euphoria of disruption. But the speed of the subsequent collapse of that value is truly astonishing.
The investment aged poorly and instantaneously. Regulatory scrutiny, driven largely by concerns over youth vaping and flavored products, intensified almost immediately after the deal closed. Less than a year later, in November 2019, Altria was forced to take a massive $4.5 billion write-down on that investment.
A $4.5 billion paper loss in under 12 months. That just shows you how volatile and regulatory dependent this modern nicotine market really is.
And it kept falling. By July of 2022, the investment was reported to be worth only 5% of the original $12.8 billion. They essentially lit over $12 billion on fire in less than 4 years. This wasn't just a bad investment. It was a crisis of valuation and market timing, stemming from the fact that Altria completely misjudged the coming regulatory hammer.
Despite that staggering near-total loss, did Altria just walk away? Or did they maintain the belief that e-cigarettes were essential to their future?
They maintained their commitment, at least for a while. They announced they would continue supporting JUUL and avoid investing in competing products. It was a signal of their dedication to see the investment through the regulatory challenges. But eventually, market necessity forced their hand.
And they pivoted to what they hope will be the new guard.
Exactly. They returned to the e-cigarette market by acquiring NJ Joy Y Holdings, Inc. They completed that deal on June 1st, 2023. This marks a strategic shift. They're focusing on products that have potentially stronger regulatory positioning in the U.S. market. It demonstrates that e-vapor is still a fundamental, irreplaceable part of their diversification strategy,
Right.
regardless of how much the initial failure cost them.
And beyond e-cigarettes, Altria is also betting aggressively on entirely new, less traditional nicotine delivery systems, specifically heated tobacco, and branching out into completely non-nicotine areas.
The heated tobacco segment is their long-term wager. In October 2022, Altria entered a joint venture with Japan Tobacco, creating a company called Horizon Innovations, LLC. Altria has a 75% stake, Japan Tobacco 25%.
And their primary goal with Horizon Innovations is to tackle the U.S. market with plume-heated tobacco sticks. What's the expected timeline for this?
The timeline really illustrates the complexity of dealing with the FDA. They anticipate needing FDA approval, which was expected to take until 2025. This means customer sales aren't even projected to begin until 2027. It's a 6 to 9 year plan from inception to widespread sales, which signals how serious they are about transitioning away from traditional combustibles, but also how slow that transition will be.
Okay, now let's look at the completely non-nicotine diversification, which ranges from recreational substances to serious medical research.
Altria maintains substantial minority stakes in these controversial or adjacent fields. The largest non-nicotine investment was in 2018, when they acquired a 45% stake in the Canadian cannabis company Cronos Group for $1.8 billion. This gives them exposure to the North American recreational and medical cannabis market, positioning them for potential future U.S. federal legalization.
And finally, the most darkly ironic element of their diversification, the investment in companies dedicated to treating the conditions that their core product exacerbates.
This is the ultimate expression of the Altria duality. As of 2024, they've invested in science and medical companies that develop products for conditions caused or aggravated by smoking. For instance, they're invested in Lexaria Bioscience, which is a developer of proprietary drug delivery technology called Dehydratech.
So their core business is based on chemically optimizing nicotine delivery into the bloodstream for addiction, and now they're investing in optimizing drug delivery technology for therapeutic purposes.
Yes. They also invested in Micreos, a biotech company focused on recombinant proteins for chronic dermatology and oncology conditions. The company that was federally convicted of racketeering for chemically enhancing addiction is now investing in potential cancer treatments. It's a closed-loop system of profit and purpose that just defies easy categorization. To understand how Altria can fund a multi-billion-dollar cannabis stake, a failed $12.8 billion e-cigarette bet, and continue to operate a freely litigated core business, we have to look at the foundational financial power of the company. I mean, historically, Altria and its predecessors were noted as among the best-performing publicly traded companies of the entire 20th century. This gives them immense stability and, very deep pockets.
Despite the massive write-downs and all the corporate surgery, what does that financial picture look like today? Is the core tobacco business still generating enough cash to fuel these erratic, high-risk bets?
Oh, yeah. The core business is still an enormous cash cow. If we review the key 2024 financials, the scale of profitability is clear. Revenue was $24.02 billion, operating income was $11.24 billion, and net income was $11.26 billion. These are immense figures that speak to the consistent, stable, and highly profitable nature of the domestic tobacco market.
But those stable figures hide the incredible volatility that the diversification strategy introduced, especially with the JUL failure. We need to zero in on how that financial shockwave actually manifested.
The net income figures perfectly illustrate the corporate roller coaster. So in 2018, before the full impact of the JUL investment hit, net income was a very healthy $6.95 billion. But look at what happens in 2019. The company reported a massive net loss of negative $1.3 billion.
A loss that year, after decades of almost ceaseless profit. That negative $1.3 billion is the direct financial consequence of the spectacular failure to value JUL correctly.
It is the absolute clear indicator of the cost of that failure. It confirms that a single strategic misstep in diversification can wipe out more than a year's worth of profit and temporarily derail the entire financial picture. But the stability of the legacy business quickly cushioned the blow. By 2020, they had rebounded dramatically to a net income of $4.454 billion.
This just shows the company's massive risk appetite. They can sustain losses that would bankrupt most other companies and still return to profitability within a year, funded entirely by the cash flow from combustible tobacco products. And that wealth translates directly into immense political influence.
Their engagement in Washington isn't supplemental, it's existential. When your product is chemically engineered for addiction and you face constant regulatory threats, you have to become an influential force in policy just to survive. And to ensure your future products like e-cigs and heated tobacco face a favorable regulatory path.
Let's quantify that lobbying power for you listening.
Yeah.
What kind of resources are we talking about here?
The figures are staggering. The Center for Public Integrity documented that Altria spent approximately $101 million lobbying the U.S. government between 1998 and 2004 alone. That expenditure made them the second highest lobbying spender of any organization nationally during that specific critical period. That speaks to a dedicated, systematic application of capital aimed at influencing legislation.
And this influence goes far beyond just tobacco laws. They delve into shaping the entire scientific and political climate. For instance, tell us more about their funding of climate change denial groups.
Altria notably funded the Advancement of Sound Science Coalition. Now, on its face, that name sounds neutral, but it was a lobbying organization created to push back against the scientific consensus on anthropogenic climate change.
Why would a tobacco company spend money fighting climate science? How does that connect to selling cigarettes?
It's a deeply strategic move. By funding groups that question climate science, Altria contributes to a larger political ecosystem that's dedicated to promoting skepticism about all government-backed or consensus-driven science, especially when that science leads to restrictive regulations. If they can sow doubt about climate findings, it makes it easier to sow doubt about public health findings regarding smoking, disease, or the addictive properties of nicotine. It's an exercise in regulatory preemption and general scientific distrust.
They also maintain extremely close ties with powerful conservative legislative organizations that focus on state-level policy.
Correct. Daniel Smith represents Altria on the Private Enterprise Board of the American Legislative Exchange Council, or ALECI. This is not a passive membership. LACIC is highly influential because it functions as a body that drafts and promotes model legislation that conservative state lawmakers can then introduce in their own state capitals. By being on this board, Altria directly influences the drafting of favorable, pro-business legislation across dozens of states at once, making sure local regulatory threats are minimized.
And their engagement reaches the absolute highest levels of U.S. governance.
It does. For instance, Altria was recently listed as a major donor, funding the White House's East Wing demolition and the planned building of a new ballroom in 2025. These are high-profile, access-granting donations that just underscore their persistent effort to maintain relationships and influence at the very apex of U.S. political activity.
So in short, their political footprint is an elaborate defense system. It shields the highly profitable core business, it combats adverse public health science, and it clears the path for their highly regulated new generation of products like heated tobacco and e-cigarettes.
It is a necessity of their business model. After being federally charged with racketeering, the only way to pivot into new, highly regulated markets is by making sure you have a highly sophisticated, multi-million-dollar political defense mechanism running continuously in the background.
So, let's synthesize the journey of Altria Group for you. We've tracked a company that attempted to chemically enhance addiction for decades, then tried to shed its controversial past with a strategic rebrand, moving from Philip Morris to Altria, hoping to evoke lofty values. And this transition was financed by the surgical spin-off of major assets, including Kraft and that massive international engine, PMI.
That new identity, however, could not outrun the past. The 2006 legal reckoning revealed a shocking level of deliberate, chemically sophisticated product design. The use of ammonia, the freebasing process, aimed specifically at maximizing nicotine transfer and speeding up addiction, all while maintaining public disinformation campaigns.
The modern Altria, therefore, is defined by its massive, high-risk financial bets on non-traditional tobacco and adjacent markets. We saw the profound financial turbulence from the disastrous $12.8 billion investment in JUL, which was then written down almost entirely. Yet they immediately followed up with the NJOY acquisition and that decade-long Plume heated tobacco joint venture.
And through all this financial volatility, the company maintained its foundational status as a powerhouse, capable of sustaining multi-billion-dollar losses. And it continues to project its substantial political influence across scientific policy, state legislation via groups like ALEX, and national politics, ensuring the survival of its ability to market and sell nicotine.
It's a company that has strategically divided itself, chemically optimized its product, and diversified into the most forward-looking yet controversial sectors: cannabis and, most ironically, medical research focused on treating chronic illnesses.
And this leads us back to the inherent foundational conflict we discussed right at the start, connecting all the threads for you as we close this deep dive. Altria operates worldwide and is a major producer of tobacco, cigarettes, and products chemically engineered for addiction. Yet it's now investing heavily in medical products and biotech companies designed for the treatment of chronic illnesses, including those caused by tobacco. If we connect this to the bigger picture, it raises an important question. As the company expands its portfolio to include potentially therapeutic or wellness-focused investments, can a business fundamentally known for creating and chemically engineering addiction successfully pivot its entire corporate purpose and public perception? Or is the original core conflict between profit and public health an inescapable part of its corporate DNA?
A profound question about corporate ethics and the limits of rebranding. Thank you for joining us for the deep dive. We'll see you next time.